Okay, let's get in a voice now. Pathik Gandotra joins in from Dron Capital Advisors on this discussion that we've been having. Hi Pathik, good morning, welcome to the show. Before I ask you about the global cues and the impact on our own markets, particularly on these Reserve Bank measures, how do you see the market move and how short-lived do you think the impact could be?
So you're already seeing the futures. The market, obviously, the financials were heavily oversold, and I think people were believing that the RBI will do anything possible to use monetary policy measures, any kind of monetary policy measures to stem the fall of the rupee. Clearly, I think there's a realization at the government and the RBI that those measures are not working. So you're attacking the wrong end of the spectrum. So I think the market will now realize that RBI is not going to use any further monetary measures to stem the fall of the rupee because they will just not work. I think that's what is going to happen in financials. So you will see obviously a pullback in financials because of that. And henceforth, when the rupee depreciates, there will not be that much of a scare in the minds of investors about RBI putting in fresh measures for financials, because they will actually tackle it from a different angle, maybe through capital flows or maybe through something else. Because India as a country cannot afford a tight monetary policy right now. Because the issue is that the growth is so bad that you really cannot spook it further, because what happens is that becomes counterproductive. The moment you spook growth, equity flows also start going out, and then you have a bigger problem at hand.
Morning, Pathik.
Morning.
But what credibility can you assign to any action from either the Reserve Bank or the government right now? Because policy is changing every three weeks. They try something, it doesn't work out, then they try something else. I mean, what is the guarantee that the last bit of the action is how their mind is going to behave over the next 6 months or 1 year?
Now, obviously, you cannot say that with certainty. But I mean, it sounds logical, isn't it? Because if somebody tries something and it does not work, you obviously change course. It's just not possible that they will actually keep on going repeating the same mistake again. Now, if you look at the rupee, if the rupee actually appreciates after RBI easing liquidity, then I think they will understand that investors are looking for more fundamental changes in India's economy and not just a carry trade between the US dollar interest rates and the rupee interest rates, and that kind of a trade. So once you do more fundamental things, I think money will come back.
So if you are convinced that perhaps the Reserve Bank may not attack the banking space or the financials any further, do you think this is a good time to be putting money into some of these extremely attractive banks? And if yes, which pocket would you look at?
So obviously, the stocks have, if you look at from bottom, they've already run up by 20% from the bottom that they hit yesterday. So you might see some kind of consolidation, because this view is not completely clear. I mean, it's forming, it's still forming. So there'll be a process of bottoming out of these financials. I would still go with the private banks. I would buy private banks. I would buy companies. I would buy banks which are good, reasonably good franchises, which will also have a story of gaining market share eventually. See, PSU banks are staffed for capital as well. They might react more in the short term because they are even more deeply oversold. But the point is, I mean, the way to go is to look at private banks.
Speaking to us, Pathik, what do you expect to see in bond deals? Now 8.3 thereabouts. What do you think is the near-term range?
So I think you'll go between 8 to 8.5%. That's where I think the yield will be. And I had one point to make. On the RBI, the issue is that you should also recognize the fact that the RBI governor is changing. There'll be a new thinking that will emerge in RBI. So it is not as if the actions are going to be so all over the place. So there's a new thinking which will emerge in RBI, which will have a different way of tackling monetary policy and forex. So I think that is what investors will look at, whether that new thinking is making decisions which are more benign towards monetary policy.
So what do you think that new thinking will be, Pathik? That new thinking will be to focus on growth and to not worry about the rupee?
I think it will be to not, when they worried about the rupee, what happened was the short-term rates went up to 12.5%. The long bond also went up to 9.25, because people started believing that now the next step is RBI will hike CRR and then repo rate. That's what was the belief. So once that belief gets shattered, again the bond yields come back. So that kind of panic, there will not be panic reactions on monetary policy is what I'm trying to say. They will curb volatility, which they have curbed. They have said very clearly that they want short-term rates to stay at 10.25. They had gone to 12.25. So there's some bit of excess there. I mean, if you take a comparison with the US, even Mr. Bernanke said once he saw the bond yields had gone up significantly, he made a point that the bond yields are too high for his comfort because they'll stall his recovery. So that is what was a point that even the central bank there said. So the issue is market force, market reactions are so violent nowadays that it becomes difficult to make policy. You shouldn't grant something to them as well, is my point.
So where does that leave the rupee, Pathik, is my question. I mean, today we are talking about growth and bond deals. What about the rupee, which till last week was the central piece that the government and the Reserve Bank were trying to address?
See, the point is, in the short term, who knows when it can be, there can be a problem as early as tomorrow if the Fed minutes are not taken positively by the market. But the point is, in the medium term, the rupee has to come back, because the issue is, the logic is that with such a steep depreciation of the rupee, you are going to see exports rebounding eventually, and exports rebounding, the trade balance will automatically correct. They put curves on imports. I mean, we are expecting the fruits of the measures to happen like in 2 days. It won't happen in 2 days. It will take 5 to 6 months to happen. And within 5 to 6 months, you will actually see the full impact on the measures that they have taken. And once all the measures come to fore, we might realize that it's not as bad as it looks like. So I don't see rupee going to 55, but I think 60 and odd is a decent range for the rupee. That's where it was actually looking undervalued. It's just that now, there's some panic and the rupee has overshot its valuation. So rupee, I think, will come back to near about 60 let me say over the next 6 months.
Pathik, how do you approach the NBFC space, which also came in for some severe punishment over the last few weeks?
That will depend upon the kind of business they are in. So I mean, companies which are focused on the industrial segment and servicing indirectly linked to the economy, there you might still see some time away before recovery happens. But stuff which is servicing the consumer demand like housing, HTX, etc. should rebound very, very sharply, is my view. The point is that, I think it's basically company dependent. I cannot make a generic statement.
What do you do with some of these expensive outperforming classes now, like IT and FMCG? Do you think they'll give up some ground?
They can give up some ground tactically, but I think IT is the place to be, because we are of the opinion that there's a economic recovery happening in the US, which will lead to rising discretionary spends and strong dollar revenue growth for these IT companies, and that's the reason for the re-rating. Rupee has been a push-up for these stocks, to go up significantly in the last 2-3 months. But the point is, the big story is still there. The big story is economic recovery in the US and stability in the EU. And so I would buy IT stocks on corrections.
What about FMCG and pharma?
There, I think FMCG, I think I'd be a bit more circumspect, because I think when the Indian economy is trudging along, you cannot have to expect to have such high valuations. Now, in the case of some of these stocks where there's been an open offer, like levers, for example, the downside might be limited, but the issue is, I mean, it may not make sense to touch it now.
The other space which has got smashed up completely is the oil space, ex-Reliance. I mean, look at ONGC at 250 odd, oil marketing companies. How would you approach this beaten down space?
Stay away. I'll stay away from the oil space.
Okay, Pathik, we'll leave it there. Thanks very much for joining in today. That's one view on the market, which is